firstly like to thank you all for joining today. I'll be looking at how you can optimise the workplace costs, as this talk is about, but this is in the context of your business rates liability. So ensuring that all of the costs under this heading within your business are correct and they are mitigated as far as possible. So firstly, I will introduce myself. My name is Melanie Oates. I am a chartered surveyor and I am Director and Head of Rating in the North East in Scotland for Lambert Smith Hampton, a firm of chartered surveyors. What my experience covers, I have had over 30 years experience dealing with business rates, and I've been involved in successive rating revaluations from 1990 to date. So that is actually 6 revaluations, and we've got the 2023 revaluation just coming up, so that will be the 7th revaluation that I'll be involved with. I act on behalf of landlord and tenant clients, public and private sector, so there's a real mix of properties and people that I deal with. So from bulk category properties, which are offices, industrial, retail, but also specialised properties which I've come to deal with over the years. There are different methods of valuation for different types of property, and I've got experience in all of those. And it's also dealing with these properties has brought me, I've had to deal with valuation tribunals, valuation appeal committees in Scotland, where we have to present a case if we can't come to an agreement with the Valuation Office Agency. So enough about me, and I'll move on to the important topic of business rates and how to keep those costs down in your business. So very simply, just looking at how your rates bill is calculated, it's a fairly simple calculation. The elements behind it might be complex, but the calculation is simple to a certain extent. So it is the rateable value of your property times by the specific multiplier, and then with any relevant reliefs applied thereafter. As these various elements are used to calculate your business rates liability, it's important to ensure that each of these elements is correct or at the optimum level. So in each of these elements we've got the rateable value, and so rateable value, what even is rateable value? Do you understand what rateable value is? Is it correct? How do you know if it's too high? And can the value be challenged? And then on the second element, has the correct multiplier been used? The multiplier is actually set down in legislation and regulation, so there's no control over that. But has the correct multiplier been applied to your bill? And then finally, what reliefs are available, and are you eligible for any of those reliefs? And how do you address any of these points, these elements in the calculation of a business rates liability? How do you address those matters? Who do you deal with? And how do you get matters changed if need be? So hopefully I can answer some of these questions today. And I think probably the first thing that is important is distinguish between what are valuation matters and what are billing matters, as there are 2 separate organisations that deal with each of those. So the different organisations that deal with those matters are the Valuation Office Agency and the Billing Authority, and it's important to understand who deals with which bit. The Valuation Office Agency are actually responsible for setting rateable values. The multipliers and any arrangements with regard to reliefs are set down in legislation, but then it's the Billing Authority who issue the rates bills in line with both the rateable value and the multipliers, etc. And the Billing Authority, which is the council, they are also responsible for collecting any of the business rates due. So any valuation matters that you have should be raised with the Valuation Office Agency, and any billing matters should actually be raised with the Billing Authority. Quite often, it's a common thing that I hear is that when people get the rates bill lands on their doormat, and nobody likes paying business rates, everybody thinks their business rates is too high, but very often people say a complaint, oh, the council have set the business rates the council have made my business rates too high. The council don't have any control over the rateable value, and that's all down to the valuation office agency. So with this in mind, what I'm going to look at is both the valuation and the billing under separate headings and the key points in relation to each. So with regard to, firstly, valuation, we'll just consider the revaluation 2023, what that actually means. We'll also look at rateable values, what they are, how they are set, what opportunities you might have to appeal the valuation, and the dealing with check challenge appeal, which is the process by which you appeal. Thinking about appointing somebody to act on your behalf if you want to do that. Then in terms of billing, rates bills, what they look like, are they correct? It might seem strange to say what they look like because many rating authorities and lots of different bills look very, very different, although they're all used to calculate the rates liability. Then look at the reliefs, what reliefs might be available to you and the eligibility for those reliefs. Communicating with the council on any billing matters, how you would do that. And also looking at if you're in a position where you have an all-inclusive rent and rate situation, how you might be billed for that and who is responsible for paying the bills and the liability in such a situation. So firstly, with regard to valuation, we're just about to embark on the 2023 revaluation. So on the 1st of April 2023, the 2023 rating list becomes live. You may have received bills already with regard to the payments that you will be making from the 1st of April 2023. And this is based on the new figures under the 2023 revaluation. Just to understand a bit about revaluations, it was set out originally in the Local Government Finance Act 1988 that there should be a revaluation every 5 years. And this progressed well from 1990 to 2010, but the 2015 revaluation was actually delayed till 2017. And then there were further alterations to the timing of the subsequent revaluation, which has actually resulted in the 2023 revaluation that we have now. So the question is, why is there a revaluation? Well, your rateable value is an estimate of rental value at a specific point in time, and each revaluation has a different valuation date. During the life of a rating list, purely economic changes just can't be taken into account. You always have to value to the prevailing economic circumstances as at the valuation date for that revaluation. And then what a revaluation actually does is it resets that, and economic factors are then reflected as they are reflected in rental values as at the valuation date. So just sort of putting that into some sort of context, the 2017 rating, for the 2017 rating list, the valuation date was the 1st of April 2015, and rateable values were based on rental values as at the 1st of April 2015. So if you think about that, they have been in force as at April 2015 for 6 years. So that's quite a long time where economic factors can't be reflected. And if you think what's happened over that time, and obviously the biggest thing that's occurred in that time is COVID and the impacts that would have had on rental values. Things like that could not be reflected in dealing with the rateable values. So the 2023 revaluation resets things again, and the valuation date for that is the 1st of April 2021. So rental values as of 1st of April 2021. Now, depending on what kind of property you may occupy, when your new bills come in, you may have seen a drop between the rateable values to reflect the difference in rental values between those two periods, or it may have gone up. Again, it just depends what the market was doing for your particular property. Just a note as well, whilst we've had 5 yearly revaluations in the past, and except for the 2017 rating, which was delayed, from now on, it's set down. The revaluations will be every 3 years. So the 2023 rating list is just for a 3-year period. So if you've received your bill through the post already, you will see the rateable value, but you might not know what that actually, how that's actually been, what it consists of. So you can actually find your valuation online at the Valuation Office Agency website. That's the address there for it, as you can see at the top. And what you'll find when you get to that screen is find a property, search either postcode, street and town, and it will bring up the actual valuation of your property. What the Valuation Office Agency website won't show, it will show rateable value, and as I say, for most there'll be a summary of how that valuation is made up. It'll also give you information by reference to a scheme number as to which other properties are in the scheme, and there'll be a description of the actual scheme that your property is included in. There'll be no rental evidence available, though, to show how the Valuation Office Agency have come about and how they've determined what your rateable value should be. That isn't held on the valuation screen. Also, properties which might be valued with reference to trade, such as public houses, there'll be no value, no reference to trade on the valuation that you can see for your property. And some of the specialised properties won't have a summary valuation. So just to give you an idea of what you can actually see on the Valuation Office Agency website, this here is the valuation for the property that the office that I'm sitting in. I'm actually in Newcastle upon Tyne, and this is the valuation for the property in Newcastle upon Tyne. And you'll see the different elements here. We've got the second floor office description. You would always make sure that the description and what's included in your valuation is correct. We then have the area square meters. We've got a 343.93 square meters of floor space, and it's been valued at a price of £199.12 to come up with a rateable value for our offices here of £68,000, and that's the 2023 valuation rateable value that will be used to calculate the rates that we pay on this property. Now you'll see here it mentions valuation scheme and a number, and what that will give you is an idea of what is included within the valuation scheme on the same basis that your property has been valued. So it gives you an idea of what the valuation office has looked at when they've created a rateable value, and it will give you details of other properties in the scheme. So just to show you on the example of our offices here, valuation scheme 61448, and it tells us that these are for purpose-built office properties in Tyne and Wear and Northumberland. So whatever property you occupy, it'll give you a description, if it's a shop, the geographic area that the shop has been, that they've contained within that valuation scheme, and then which other properties are in the scheme, and you can have a look at the list of properties that are included on the same basis, and then it'll give you the parameter of price ranges within that scheme. So that will give you some idea of how the valuation is actually made up on your property. There is the opportunity to appeal your rateable value. You would do this, as stated previously, by putting in or going through the process, the check challenge appeal process with the Valuation Office Agency. This is done via the government gateway, and you may do that for tax purposes and whatever other purposes. You may already have a government gateway account, but there's a separate area there for business rates valuation, and you log on, create an account, and you will then be able to see a more detailed evaluation. It will give you a little bit more detail than you can see on the Valuation Office Agency website. And what this actually does, it then allows you to go through the process of the check challenge appeal to challenge your rateable value, to try and get that rateable value down. This does take the 3 stages. The check deals with the physical elements of any valuation. So if I just go back one side, if I look at this valuation of ours, and I think that this area here, if I think, well, actually, that's the wrong floor area, or if you have a property and it has, say, this says 2nd floor office, if this had a 1st floor and 2nd floor office noted, and I think, well, actually, we just occupy a 1st floor. On the case of your property, maybe it has an additional outhouse or something of that nature, and you think that isn't included in my property. What the check stage of this system deals with is to correct any physical elements of the valuation. So you just log on, you'd be able to tell the valuation office agency what the differences are, and you would just provide some evidence to show that they've got the physical elements incorrect. And at that stage, they will correct any physical differences that should be corrected. You would then get, after that, you get a check decision back. And once you've had a check decision back, you can then submit a challenge. This will be your chance to put down the detailed submission relating to the actual valuation side. So the price per square metre on your valuation, that is where you'll be able to put in a more detailed submission and your argument and evidence to say that that's too high and why it should be reduced. You'll then get a challenge decision back. The VO may or may not agree with what you've said there, and the final stage would be to, if you wanted to, you'd have to make an appeal to the valuation tribunal, and in that valuation tribunal, you would appear at valuation tribunal and put forward your case. I've been talking there of you doing things and challenging your own rateable values, etc. You obviously have the ability to do that. You can, however, also appoint an agent to act on your behalf. That is entirely up to you whether you want to do that. It is a complex system, the business rate system. There's a lot to it, but you can go through that yourself, or you can appoint an agent. Now, you may have had many people sort of ringing you up or knocking on your door, trying to get you to sign up with them. I would say always use a member of the RICS. Members of the RICS are regulated and they are subject to the RICS rules and regulations, and so always use a member. I've given a link there to the RICS, and what that does is you can look on the RICS website under Find a Surveyor. But what you can also do, this helpline will give you access to 1 or 2 people there who you'll probably be able to get some time with on a helpline to just have a discussion with and see, probably determine whether you need to appoint an agent to act on your behalf or not. So, as I said, the important thing there is always use a member of the RICS when dealing with your business rates, any business rates appeals. So that's sort of in a nutshell is on the valuation side of things. And just to reiterate, the valuation, any issues with that, it's all addressed to the valuation office agency who would deal with that side of things. Moving on now to billing. Just to recap on that, calculation of your business rates liability is rateable value, which is what we've looked at and the potentials you have there to influence that. And then multiplied by the multiplier. The multipliers are actually set down in legislation, so they are what they are, but there are 2 different multipliers, so you just need to ensure that when you get your rates bill, that the correct rate, the correct multiplier has actually been used to calculate your bill. And then finally, there are a number of reliefs that are available, and you just need to check what those relevant reliefs are and whether you are eligible to have any of those reliefs applied to your bill. So as stated, there are 2 multipliers in force for the 2023 rating list, and the standard multiplier is 0.512 with a small business multiplier of 0.499. And the small business multiplier is applied to a property which has a rateable value which is less than £51,000. So if you have a rateable value less than £51,000, you need to look at your rates bill and just make sure that that small business multiplier has been used to calculate your liability. I've just got an example here of a rates bill, which hopefully you can see. So this is a larger property, but we see here we've got a rateable value of £132,000. The bill here sets out the two multipliers, but what we'll see on this side of the bill is that the rateable value times the 0.512 multiplier gives the a liability for the year £67,584, and that is what the calculation of the bill is. So simple elements there on the bill. This is a fairly straightforward bill, just with the RV times the multiplier, what that means. Just as a quick look at this bill as well, you will have your payment instructions on your bill. Now, this is set out in 10 instalments. Just a quick thing here to say is that if it will be set out usually in 10 instalments, you do have the right to ask the billing authority to change that to 12 instalments if you feel that helps your cash flow with your business. So you can have, that is one matter that you can have altered by the billing authority. Now, in terms of any reliefs, there are quite a few reliefs available, and I will just run through a few of these. The first one that we'll look at is transitional relief, which is actually an automatic relief based on increases in rates liability between one year to the next. We'll look at small business rates relief, SBRR. Supporting small business relief, SSBR. There's lots of things that sound very similar, but we'll go through each of these. And then retail, hospitality and leisure relief. So I'll just look firstly at transitional relief. As discussed previously, with regard to rateable values and with the reset of the values with 2023 revaluation, there may be some rateable values which have jumped up significantly from the 2017 values. What transitional relief is, it's a measure to actually limit the increase in business rates bills brought about by the revaluation. So you may have an example where your rateable value has jumped by 50%, and you might think, oh my goodness, my bill's going to jump by 50%, but the transitional relief limits the increases on bills from one rate year to the next. So looking at the current rate year coming up, which is 2023, if you have a rateable value of less than or equal to 20,000, or actually 28,000 in Greater London, then your bill will only increase to a maximum of 5% over what you paid last year. That transitional relief will continue into 24-25 with a 10% increase above the previous year, and then 25% in the previous year. And you always get the maximum you will pay will be RV times multiplier, but those transitional limits will be applicable each year to limit any increases that come in. Rateable values between 20,000 to 100,000, it's 15% this year, and anything greater than 100,000 rateable value, it is 30% this year. So that just gives you some idea of the measures that the government have brought in on transitional relief to ensure that business rates are tapered in and phased in, so that there are no big increases. There used to be transitional phasing has existed in every revaluation, and there used to be phasing the other way, so that decreases in bills were phased in, but there's no decrease this time. So you will, if your rateable value has dropped, you should get the benefit of that reduction in the actual rateable value.
Melanie, sorry to interrupt. There's a couple of questions in the chat box. If you can see it. That's all right, no problem at all.
Can I take, do you want those, shall I take those now?
Yeah, if that's okay.
Yeah, not a problem. Yes, the community interest company, I think anything billing wise, that would, that's obviously with regard to the, on the billing side of things. I think when I finish up, and I'll run through other reliefs, but when I finish up, they are, the billing authority have a very good website with all of the available reliefs. And I think anything with regard to that, always check out what the billing authority, what their website says. So registered charities do get a discount to get the 80% charitable relief, which is mandatory. You have to be a registered charity, and the discretionary relief comes thereafter. So check with the actual authority as to what they do themselves with regard to matters like that. Right, and yes, I'll be coming on to charitable rates relief and discretionary rates relief. I will be doing that. That will be something that I'll cover as we go on, and hopefully that's covered those for the minute. So just looking at the transitional relief, on this particular bill, what you'll see here is that, just going back to the multipliers, there's a £93,000 rateable value on this. We will see there that there's transitional phasing, and that's been included at 15%. So basically, there's a credit being made, which is with regards to the transitional adjustment, and therefore you don't pay the full RV times multiplier, you pay less than that because of the transitional phasing. And then what I'll come on to next is small business rate relief. So for small business rate relief, this will apply at 100% relief for any properties with rateable value £12,000 and under. So you get 100% relief at 12,000 and under, and between rateable value 12,000 to 15,000, you get tapered relief from 100% to 0%. So in the table below there, you'll see that you get 100% at 12,000, 13,500, it's 50%. So that just gives you an idea of where the values will, the percentage reduction will fall, and the sliding scale for that. Now, in terms of eligibility for the small business rate relief, a ratepayer must only occupy one property. You can have other properties, but if there are additional properties, and these are occupied, each must have a rateable value below 2,900, and the sum of the rateable values on all properties must be less than rateable value £20,000 or £28,000 in Greater London, and the relief will only be applied to one property. So a good example of this is if you say have an office property, it has a rateable value of say £10,000, but you might have say some parking spaces, and they might be valued at less than £2,900. Having a car parking space, for example, or any property below 2,900 would not knock you out of eligibility for the small business relief on your main property. You would, however, pay the full amount. You wouldn't get any small business relief on the second value, which is under 2,900, but it wouldn't knock you out of the eligibility on your main property. And if you do take on a second property, you're getting relief on one property, and you take on a second property, that won't again disqualify your eligibility on the original property, and that will remain in place for a year. Now, the supporting small business relief, that comes about where with regard to a revaluation, and this revaluation where ratepayers have lost some or all of the small business relief that applied in 2022-23, and that has come about purely because of an increase in your rateable value as a result of the 2023 revaluation, and any increase on bills with regard to that is limited to £600 per annum. Now, the example of this, and I will admit that I've taken straight from the government literature on this, because it's a good example to give. But if you had a rateable value under the 2017 rating list of rateable value £3,000, you would have been getting 100% small business relief. Under the 2023 rating list, because your rateable value might have increased significantly because of the changes, as we've discussed previously, to rateable values, then the bill, you'd get the transitional relief and you'd also get small business relief, but your bill would still go up to £1,047.90. So it's considerably more than the 100% relief or the zero that you were paying the last time. So with regard to this, supporting small business relief would apply, and your bill would be reduced to the limit of the £600. So that's quite an important relief with regard to any significant changes where you would be losing the benefit of the transitional relief because of the revaluation. I'll also mention at this stage retail, hospitality and leisure relief. This under the in 2022-23 was actually 50% discount that was available, and this has been increased in the rate year 2023-24, and it's now 75% discount, and this applies up to a maximum of £110,000 per business. So if you have a number of properties, you will be able to get that 75% discount on your rates liability, providing you don't go over £110,000. It will be limited to that. With regard to this eligibility, it will apply to shops, restaurants, cafes, bars, pubs, cinemas, hospitality and leisure businesses such as gyms. Always check the council website for more detail, because there are some exclusions to that that apply, and sometimes on shop properties with regard to, say, some form of financial institutions such as banks, etc., but other financial institutions. So just double check what the eligibility is. It will all be included on the council website with regard to that. I've included this because there may be situations where you have an all-inclusive rent and rates agreement, and one of the easiest examples to understand on this is serviced offices. Now, depending on the nature of the operation of the serviced office, which I'll use as the example, there may not be individual rating assessments for each separate office at all. And if there isn't, there'll be one bill for the whole suite, and the landlord will discharge that, and you'll be paying a proportion of that through your rent and rates inclusive agreement. If, however, there is a separate assessment for an individual office, then an individual rates bill will be issued by the billing authority for any separate office. Now, what you would need to do on that basis is you would look at the agreement you have with the serviced office operator or any other operator where it's a rent and rates inclusive agreement, and that will state whether business rates are included in the rent paid to them. And if rates are inclusive, then even if it is the case that an individual bill is sent out to you, if the agreement is with the operator is that they are liable for the business rates, then they would be responsible for paying that individual bill. So always check what your arrangement is with the provider if you're in a situation where there's an inclusive rent and rates agreement. So we discussed before about the valuation office agency and how you would appeal rateable values and the channels you would go through there. For any billing errors, communicate that with the billing authority. So when you get your rates bill, it will be issued and it will contain contact details. So look at the various elements. If you think there are any issues with regard to your bill, then contact details will be on there for you to be able to contact the authority about that. What you may find is that you may have an e-billing system for online management of your bill, and you'll be able to contact and raise issues with the council with regard to that. In terms of the reliefs that we've spoken about, then these may be applied, some of these may be applied automatically, but there may need to be an application process. With regard to small business relief, for example, you may need to make application for that, because there'll be a declaration on eligibility with regard to that, because it's a specific circumstance about, do you occupy more than one property? And it's not just a property within the one local authority area. If you occupy other properties in other billing authority areas, then that will count towards the small business relief eligibility. And so you would have to sign a declaration to be able to get the small business relief applied to your property. Transitional relief will be applied automatically. Retail, hospitality and leisure will probably be applied automatically, but just check, and if there's anything that you think needs to be dealt with regard to billing, then have a look at that. The question with regard to discretionary relief was raised earlier. Again, check the council website on that, and any issues you have with regard to that, and any application process you have, then that will be available on the website, the council's website, and they will be able to tell you exactly what the processes are for claiming any discretionary reliefs. Just to note that the council, the billing authority, will only be able to communicate with the ratepayer on matters. So if you have an agent acting on your behalf, they would not be able to contact the council to sort out any billing matters unless you gave them specific authority to do that. They'd have to have a letter of authority that would then need to be produced to the council so that they could act on your behalf to speak to the council about these matters. But otherwise, the council will not be able to speak to anybody other than you as the ratepayer to sort out any issues with regard to your bill. And you've probably may or may not have accessed the business rates section of the council's website, but I've just put a link on the bottom there, and it's a good website with lots of information with regard to business rates, so do check that out. It's very, very informative.
Thank you for coming along today to hear me talk about optimising workplace costs and staff morale. I'm going to be coming at that from a employee benefits perspective, and hopefully come up with some strategies for you to consider for your workforce. So just to introduce myself, I'm Head of Employee Benefits here at PK Group. We're a financial solutions company based in London and the South East. We cover all different disciplines of personal finance and corporate finance. So we're here to support employers and employees alike. What I'm going to be looking to cover today is, as I said, that highlight topic of staff morale. We're going to look at employee benefits. What does an employee benefits package look like? Things for you to consider, just to remind you about your pension requirements, and then at the end, some strategies for you to consider around those things that we've touched on. If you've got any questions, by all means, you can mention those in the chat, or happy to take those at the end. So what do employee benefits look like? I'm coming at this from a perspective of companies of below 50 employees. We support companies of all different shapes and sizes, and we support all different forms of benefits. Typically in the UK, there is a split in benefits between what's called core benefits, which are your usual pension, life assurance, and private medical insurance, and other contractual type benefits, and then additional, or sometimes referred to as lifestyle benefits, those that are optional for employees, ones that they can pick and choose between whether they utilise or not. So what we're going to do to start with is just run through those benefits and some things for you to consider. So the first one to look at is the life insurance, and we're coming at this from the perspective of staff morale. I think employees would compare their benefits package to their peers, their friends, in other job roles. And amongst small to medium-sized enterprises that we've spoken to, which over the years is probably running into the several hundreds of employers, around 85% of companies in that space offer group life assurance for their employees. A good benefits package can go a long way to improve staff morale, and group life assurance is a cornerstone of that. As it sounds, life assurance is ensuring the individual employees in the event of their death. Typically, it's based on a multiple of their salary, and in the UK, the standard is somewhere between 3 or 4 times a multiple of their salary. Benefits are payable tax-free to a nominated beneficiary, typically tax-free to their nominated beneficiary. A lot of these benefits that we're going to go through today, just to highlight, premiums are generally an allowable business expense from an employer's perspective, so can be tax efficient for you as well. And the next of the core benefits to consider would be private medical insurance. Again, typically somewhere between 40 and 50% of the companies that we've spoken to in your space would offer a form of private medical insurance to their employees. Just to recap, private medical insurance is about giving employees access to early treatment in the event of them needing some form of medical attention. The purpose of that is twofold: A, improving the employee's life in that they're getting seen quicker, but B, from your perspective as an employer, actually they're being seen quicker and therefore returning to work sooner should they need medical attention. Importantly, the premiums on this from an employee's perspective, anything employer funded is a taxable benefit, but employer premiums again can be a business expense. The next insurance that forms part of the core of what we would typically see is income protection. This has become more popular in recent times, and we're attributing that mainly to the government's furlough scheme. Employees have come back to work after the pandemic and have got one eye on how they would be remunerated in the event of them being on long-term sick due to illness or injury. An income protection policy would pay out a percentage of the employee's salary to the employer to pass through payroll to pay to the employee until they're fit to return to work. It's an insurance that is becoming more and more popular again. The final one for us to just touch on, and it is again, since the pandemic has really come into its own, is employee assistance programs. These are telephone-based or face-to-face counselling support for employees for everyday life stresses. Mental health has been a very hot topic for employers and employees. Since the pandemic, it's really come into focus. And employee assistance programs really gives employees the ability to speak to someone in the event of having challenges in their lives. Employers are seeing this as an important part of any benefits proposition. So the final one of the core benefits that I touched on was pensions, and I've given this its own separate section because this is a place where all employers have a cost nowadays because of auto-enrolment. Auto-enrolment was introduced back in 2012, and it's meant that all employers now are required to have a pension scheme. So I wanted to just look at what those requirements are, because you've got a cost, and if we're thinking about staff morale, really you need to look at benefits in the whole. So actually you need to look at everything that you could consider and how you're spending your budget as an employer, and therefore the difference you can make to your employees. So just to recap on pension rules, employers are required by law to offer employees a qualifying workplace pension scheme. Those who are eligible employees, and that's all employees over the age of 22 and earning over £10,000 per year, and importantly below state pension age, those eligible employees have to be automatically joined to a pension scheme, and certain regulatory communications have to be passed to those employees. When an employee is joined to the pension, the employer has to contribute and the employee has to contribute as well. There's a minimum requirement in terms of total contributions, and a minimum standard of contributions, which is known as qualifying earnings. Qualifying earnings are all earnings between a lower earnings and an upper earnings threshold, and you, the employer, dictate the rules that you apply to your pension scheme, and those rules can be various, but there's certain minimum standards that are required. Once you've completed that process of rolling people into a pension scheme, every 3 years you have to complete a declaration of compliance with the pensions regulator, and that declaration just explains to the the regulator exactly what happened on your scheme. In terms of pension contributions, typically in the UK, pension contributions are paid from an employee's net pay. So this is known as relief at source, and there's an example there on the screen which shows you how it would typically work. Pension contributions are a tax efficient method of saving for employees' retirement. So employee pension contributions within certain limits will receive full tax relief. So for a basic rate taxpayer under the relief at source method, an employee would have a deduction from their net salary that's paid to the pension provider by the employer, and then the pension provider would reapply basic rate tax relief. So in that example, where an employee is looking to pay £100 into their pension, they would see £80 deducted from their net pay, and pay to the pension provider. The pension provider would replace or add back in the 20% tax relief, therefore bringing the contribution up to £100. Higher rate taxpayers complete their self-assessment form each January, and that is where they would receive their higher rate relief, which is often one of the areas that employees or individuals forget to do. It's one of our biggest areas of support for the companies that we work with, is explaining to employees about pensions tax relief, and the importance of reclaiming that higher rate relief. So just reminding your employees of that as an employer could be a good way to get on their good side in terms of saving them money in the future. So that was a really quick run through of what a comprehensive benefits package looks like. So from a staff morale point of view, it's combining all of those different elements and giving your employees access to those things to be able to support them based on your demographic. That could be a different makeup of all of those benefits, and based on your industry or sector type, again, could be completely different based on those things. So I think it's important for you to have a good breadth of knowledge of those things when you're considering staff morale, because benefits have really become a popular topic of conversation for employees, and certainly in the current climate when employees are considering their role, staff retention is key to having a decent benefits package in place. So what I'd like to do now is just move on to a couple of strategies for you to consider. So strategy number one, in my opinion, would be to think about those pension contributions. So again, in the UK, typically pension contributions are paid from net pay. An alternative method to consider is to utilise something called salary sacrifice. Salary sacrifice is where pension contributions are deducted from the individual's gross salary prior to paying tax and national insurance. So in that previous example where we went through where the employee wanted to pay £100 into their pension, under salary sacrifice, the employee would sacrifice £100 from their gross salary and therefore not pay tax. But importantly, they would not pay national insurance as well. So for a basic rate taxpayer, they're instantly saving 12% on their whatever they're paying into their pension contribution. And therefore, it's making their pension saving cheaper and more cost effective. Importantly, salary sacrifice is a change to employees' terms and conditions. So it might not be right for everybody, but I'm suggesting it's something you could consider for your pension scheme to make it more tax efficient for employees. There are things to be aware of in terms of the impact on statutory benefit entitlement. Again, we can explain that, or in the public domain, it's very well publicised. In terms of a benefit of this strategy to you as the employer, you would receive a reduction in your employer national insurance bill by 13.8% of that employee's pension contribution. So in that example, where the individual was paying £100 into their pension, you would generate, for every £100 sacrificed, £13.80 as an employer as a reduction of your NI bill. If you multiply that by the level of contributions that your employees are paying per year and the number of employees that you have that this could be appropriate for, that's potentially some significant savings that we work with employers to come up with strategies to potentially reinvest. So it's either a way to save you money as the employer to reinvest in benefits, or it's a way for you to reduce your salary bill. So that's strategy number one to consider. Strategy number two is to actually look at benefits. So we touched on all of those benefits previously in terms of the core benefits. And it's important to consider some of these are particularly low cost benefits, and they have a number of add-ons. So we talked about life assurance or income protection and private medical insurance. Those benefits have additional services within them, typically dependent on the provider that you choose. Group life assurance is one of the more cost-effective benefits available to employers, and group life assurance is an attractive benefit for employees because it reduces the need for things like medical underwriting in most cases. If you offer your employees a group life assurance, there's a number of providers out there now that have add-on benefits like virtual GP services or employee assistance programs, which is one of the things that we've touched on earlier. So a strategy to consider would be to look at the benefits that you are either offering or considering and look at what other add-on benefits that they can offer staff, because it's those benefits that have really added extra value for employers and employees alike. Having a well-rounded proposition like that can control your benefit costs as an employer, but really can make a difference to employees in the way that they're interacting with their benefits. Strategy number three would be some of those lifestyle benefits that we touched on. So in terms of controlling cost, these are typically either low-cost benefits to you as an employer, or they can be operated on a voluntary basis where the employee funds them through salary deduction. It's a strategy for employees to improve their morale, because generally morale, it can be linked to various home stresses and strains. One particular strain right now is the current financial crisis. cashback benefits in those lifestyle arrangements that we touched on, like health cash plans or dental schemes, where an employee in their general day-to-day life has health expenses. These benefits give employees a refundable budget to claim in the event of having to spend out on any of these health spends. So things like if they have to go to the dentist or they need to get glasses, they can receive a refundable budget towards those costs, which means in terms of morale, you're helping their pocket at the end of the month by giving them cash back through an insurance policy. Strategy number 4 is considering, again, within those lifestyle benefits, the tax efficient ones. So utilizing salary sacrifice benefits to, again, keep costs down for you as the employer, but also give employees access to valuable benefits through the most tax efficient means by creating tax and national insurance savings utilizing salary sacrifice. Some of the benefits that you can choose from would be the Cycle to Work scheme, which a number of you may have, that has been extended out to electric cars now, which are becoming a very popular benefit. And there's also other potential salary sacrifice schemes out there that you could consider. So there's a number of different strategies and that we work with, and I know Vicky's going to share these slides at the end. And I think the key message from me in terms of staff morale is we look after just short of 15,000 employees across the UK. Everybody is struggling at the moment to make ends meet. I think you can utilise your benefits package, whether that's your existing budget or creating additional budget by how you pay your pension contributions. You can create a strategy of your benefits to improve your staff morale and really make a difference to your employees. That was a very quick run through of what I think would be a useful way to optimise your workplace spend and improve morale. If there's any questions, I'm happy to answer them, and if not, there's my contact information that will be on the slides, and the all-important compliance part that we have to supply.